Most retail traders watch the price. The ones who understand why it moves have a real advantage. And one of the biggest drivers of currency markets is something called central bank policy. Specifically, whether a central bank is hawkish or dovish. That single distinction can explain some of the sharpest moves you will ever see in Forex. So what does hawkish actually mean? The word comes from the image of a hawk, aggressive, decisive. In economic terms, a hawkish central bank is one that prioritizes fighting inflation over supporting growth. That usually means raising interest rates, or at least signaling that rate hikes are coming. The opposite stance is dovish, preferring lower rates to encourage borrowing and spending. Central banks like the US Federal Reserve, the European Central Bank, and the Bank of England set benchmark interest rates for their economies. When a central bank raises rates, borrowing becomes more expensive. That slows spending, cools the economy, and puts downward pressure on inflation. Most major central banks target inflation of around 2%. When inflation runs above that, the pressure to go hawkish builds quickly. Here is why Forex traders care so much. Higher interest rates make a currency more attractive to foreign investors. If you can earn a better return holding US dollar assets, demand for dollars rises, and so does the dollar's value. This is why even a speech from a central bank official can move a currency pair within minutes. Traders are not just reacting to rate decisions, they are listening for any signal that a shift is coming. That shift is what you want to learn to spot early. Rising inflation data, strong employment numbers, cautious language from central bank governors. These are the signs that a bank may be moving in a hawkish direction. The minutes from policy meetings often reveal internal debates before any public announcement. By the time the rate hike is official, much of the move in the currency may already have happened. Markets are forward-looking. They price in expectations, not just reality. Also worth knowing, hawkish and dovish are not permanent labels. A bank can flip its tone quickly if new economic data forces it to. That is when volatility spikes hardest. If you're trading around central bank events, that is exactly when risk management matters most. Unexpected hawkish surprises can move markets sharply and fast. Stop-loss orders and appropriate position sizes are not optional, they are essential. Trading involves real risk, and no fundamental analysis, however sound, eliminates that. The practical takeaway: start reading economic calendars. Track inflation reports and employment data for the major economies. Note the language in central bank statements and compare it to what was said before. Spot the shift in tone early, and you will understand currency moves that confuse most traders.